Well, boys, the stock market is finally starting to break, and I could not be happier. Welcome back to Strongman Personal Finance. If you haven't checked the market this morning, which it's very important that you check the market every single day to see whether stocks went up or down. If you've checked the market, you may have noticed that the indices are down like 1.62%, and we have a pretty nasty start to the 2025 stunk year. Now, why is this happening? Well, the most obvious reason is that more people are selling than buying stocks. That's always what affects short-term price fluctuations. That's how a market works. But there are some very, very, very big long-term risks when it comes to inflation that are being priced in specifically into the bond market. So whenever you're investing, you have a choice. You can buy Treasury from the government, from the federal government, and get a risk-free rate. Because theoretically, the U.S. government can never default on its debt because we issue our debt in our own currency. And worst case, the central bank can just buy debt directly from the Treasury. I don't know if that's a good thing, but they can do it. So the U.S. is never going to technically default on its debt. But there's a structural issue in the United States where we are running up massive deficits, especially as a percentage of gross domestic product. So if you're a bond holder, you're considering buying a bond, you want to make sure that you at least beat inflation, right? You want some safety and you want to beat inflation, because the last thing you want to do is buy a bond from the government. Let's say it's paying 4% per year, and then you find out later that inflation is 6% per year over that entire time frame. Well, in real dollars, you've lost money. You haven't even preserved your capital relative to inflation. So what you notice is that the Fed is cutting rates on the short end. That's basically what they control mostly. And you can see short-term Treasury yields have gone down. But long-term Treasuries are starting to go up. As a matter of fact, the 30-year Treasury is hovering right around 5%. The 10-year, I believe, is 4.75%. So if you're an investor and you want safety, you don't want to be worried or, have issues with the business cycle. Sometimes stocks go down. You want a nice, steady income. You can scoop up risk-free U.S. government treasuries, 10-year for 4.75 and a 30-year for 5%. So when you're faced with that, and the expectations of inflation are starting to creep up again around the world, what do? Do you buy stocks or do you buy treasuries? Well, I think some people are probably considering that treasuries might be a better place to park their money. And yields are going up because of inflation expectations. So that could naturally have a weighing effect against stocks, where stocks go down, but treasuries also go down because yields are rising. When yields rise, when interest rates rise, bond prices fall. So there's really not many safe places out there except short-term treasuries, to be perfectly honest with you, like SGov, for example. But the stock market's starting to fall. And I think it's a very healthy thing, because despite what y'all think about how stocks work, you think they just go up 23% per year, and you think that if you just buy the dip, it always vertical lines after. That may not actually be the case going forward. And sometimes stocks have bad years, and it's not a bad thing if stocks start to sell off, because we are at historically high valuations. Justified or not, there is the risk that we are in a bubble. I personally think we're in some kind of bubble euphoria, which could go on for a long time, but I can sense it with the amount of retail engagement in the stock market and, just the stellar returns that are drawing in people like moths to a light. So it's a combination of inflation fears and, probably treasury yields is what I'm thinking. That all ties together. So what should you do going forward? Should you buy the dip? Should you wait a little bit and hold out in cash? Well, if you're a short-term trader and you really only care about short-term performance, I don't know what to tell you. personally. I mean, you may think you should buy the dip, but the dip could keep dipping. Treasury yields could keep going up. Inflation expectations could keep going up. If you're a long-term investor, like I always preach on this channel, it doesn't matter at all because your time horizon is long. And the more the stock market dips, the cheaper you're able to buy your favorite index. Okay? That's a good thing in my opinion. So if you're, dollar cost averaging, you're going to be perfectly fine in this quote unquote market crash that we're going through. And we definitely needed this. Okay? The euphoria was getting to stupid levels. It was getting stupid. And when euphoria gets to that level, when everybody's bullish, when there's a mania, that tends to lead to negative future returns. And I actually believe the S&P 500 will not return that well over the next 10 years. That's my personal opinion. But if your time horizon's long enough, it really doesn't matter. You don't need to really stress about it that much. I mean, if VT went down to 60 or 50, I wouldn't care. Because every paycheck, I'm putting $1,000 into it. Every January, I'm trying to max my IRA. And over time, I think I'll get a good price for VT. But if you're a short-term investor, if you're panicking right now, you need to really reconsider your investment philosophy. I keep trying to pound this into your heads that if you buy highly volatile, high beta stocks, you can look like an absolute vertical line genius during bull markets. But when bear markets come around, you get absolutely annihilated. And you have to always factor the risk, and you always have to think about lifetime total returns. It's never about annual returns. I don't care that stocks went up 20% in both years. It's nice, I look rich on paper, but how I think of investing is I'm the partial owner of every business in the world at market cap weights. And when I hit my retirement age, I'm going to have a certain percentage of all those companies, 0.001% probably, and I'll be able to live off all of the profits that those companies generate, forever into the future. That's the only way you should think about investing, is acquiring more and more shares of your target index. Stop focusing on returns in the short term, because if you're not going to use the money, it doesn't matter. I'm not selling VT. I don't know. Maybe I'll never sell it. Maybe I'll have so much money that I could just live off the dividends. I don't know what's going to happen. But that's how I think about it. So stocks go up, stocks go down. It doesn't matter. It's how many shares of the market, how many shares of VT am I acquiring? And going into the future, I'll be able to live off all of the profits that all of those companies spit out forever into the future. And, whatever you have in retirement is basically what you have. You can't really assume any returns. You don't know what the returns are going to be. It's all about acquiring as much as you can by focusing on income instead of timing the freaking market and trading back and forth and being a freaking degenerate. So the market's melting down. I don't know when the bottom is. I hope it drops 40, 50%. It's much needed. The grifters are becoming too powerful again on YouTube. It's actually worse than 2021. The fraud is astronomical, and the fears around Trump's administration are actually justified. I mean, he's antagonizing all of our allies. He's saying all this crazy stuff. He's, threatening tariffs. There's too much uncertainty right now. And I think the next 4 years are going to be highly volatile, because if the market's not certain, it doesn't know how to react. And you can see huge swings. And with Trump as the president during the second term, more experience.